In this video, I will go over the nature and role of financial markets and institutions. Financial markets are where financial securities like stocks or bonds can be bought and sold, and commodities can be bought and sold. High-value commodities like, say, gold. Financial markets are where those who need funds can meet those who have funds, and they will supply these funds for a return. So a company who needs to raise money can go to the financial markets and sell securities or bonds that offer a certain rate of return. Investors will buy these securities if they meet their required return. Financial markets facilitate organizations to raise capital, to manage risk or transfer it. For example, like foreign exchange risk can be managed with the derivatives market. International trade, so by enabling organizations to buy foreign currencies in the currency markets, enabling them to trade internationally. As I already said, match those who need capital with those who have it. Capital and money markets. So what are capital markets? They are where debt and equity are traded. They are markets where longer-term investments are sold. The organizations who seek finance from these markets are seeking long-term finance. The main securities sold in capital markets are public sector and foreign stocks, company securities, and Eurobonds, also called international bonds. These are bonds that are in a currency that is not the national currency of the issuing company. So a US company could issue an international sterling bond. There are national and international capital markets. National markets tend to be smaller. International markets enable organizations to access foreign currencies. The main international markets are the euro markets and the foreign bond markets. The euro market is an international capital market organised by international commercial banks, where financial institutions buy and sell currency deposits that are not held in their country of origin. Companies who have a high credit rating can raise finance in a foreign currency. Money markets are used by companies to access short-term funding for, say, liquidity and working capital purposes. They offer investors shorter-term investments where deposits that are not needed now but may be required in a year or so. These deposits can be invested and earn a return for the company or the investor. Financial intermediaries. You now know the financial markets are where those needing finance can meet those who have the funds to invest. But the market is full of all different types of organisation and investor. The role of the financial intermediaries is to bring these parties together. Through an intermediary, investors can put their money and it is invested on their behalf. So the receiver receives the money indirectly because it comes through the intermediary. Typically, it works like this. People and organizations with funds deposit their funds with an intermediary. For example, you deposit your savings with a bank. This is an intermediary financial institution who lends out your funds to borrowers at a higher rate of interest that you will earn for your deposit. Although your money has been loaned to a borrower, you will have no contact with the borrower. Examples of financial intermediaries are banks, building societies, finance companies, pension funds, insurance companies, and investment trusts. These intermediaries fulfill the following roles. They aggregate small investors' deposits together to supply a large borrower. So, for example, a pension fund may be made up of lots of investors who have each put in, for example, $1,000 invested. But the total value of all these investors could be $1 million. This $1 million can be invested into one big borrower. Individually, these investors would not have been able to invest in such a big project. Risk transformation. This is where investors' funds are attracted to low-risk securities. They are then issued to the borrower, who is a higher risk. Sound confusing? So, think about a normal merchant bank. They offer you a 3% interest return on your deposit and a guarantee that you will be returned your deposit within 1 week of requesting it. So it is a low-risk security for your funds. The bank, in turn, would issue your funds to a high-risk investor. In finance, the higher the risk, the higher the cost of finance, or the higher the return must be for the investor. This high-risk loan will be issued to a borrower at, say, 20%. Your money has been loaned out at a 17% more return than you receive for it. This is because the intermediary is taking the risk. Maturity transformation. Often those who need finance need it for a longer period of time than the investor has the finance available. So take, for example, somebody wanting to buy a house. They save their funds for a year. They deposit these funds with an intermediary for a year. The intermediary issues these funds to a long-term borrower, say for 20 years. Even though the two parties' timeframes are different, it is okay because the financial institution is receiving deposits from other investors when the person who wants to buy their house, the original person, withdraws their funds. Other deposits can be used. So the intermediary in this situation can satisfy the borrower's finance maturity needs and the investors. What is the stock market? A stock market is also called a stock exchange. It is a collection of markets where equity is issued and traded. The role of the stock market is to facilitate companies issuing equity to investors, facilitate the trading of shares and stocks. The stock market offers security to investors and companies by acting as a clearinghouse for the transactions, which ensures payment from the purchaser of shares and delivering of the shares from the companies selling them or issuing them. Shares can be traded easily on the stock market. This means that investors can quickly sell on their investment, making it more attractive to invest. Here's an example of what can be traded on the stock market. Issued shares of public companies, which are equity, corporate bonds, this is a debt instrument that can be traded as well as issued, government bonds, and local authority loans, again debt. What is the corporate bond market? A corporate bond is a form of debt financing issued by a company directly to an investor that offers a rate of return. So the company has issued a bond instead of, say, going to a bank for a loan. These are sold by the corporation to raise finance. Bonds can be secured. This means that they can use a specific asset for collateral. This reduces their risk. Unsecured bonds do not have collateral backing on them. Only the issuing companies promise to pay. Governments also issue bonds called government bonds. Government bonds are considered to be less risky than corporate ones, so offer a lower return. When discussing the rate of return of bonds, you talk about bond yield. A bond is different from shares because it is a debt instrument. When an investor invests in a bond, they will get the yield from the bond, but they will not own shares in the company like they would if they had bought equity in the company. Corporate and government bonds are issued on a specific market, the bond market. This is a primary financial market where companies and governments can issue the new debt. Once issued, they can be traded on a secondary market like the stock exchange. I've touched a little on the concept of risk and return. Investors invest to make a return. When they invest, they must assess the risk of 1. Not making a good enough return, and 2. Losing the funds they invested. Investments are categorized according to their level of risk. The general rule of thumb is the higher the risk, the higher the expected return. Let's go over some common securities traded on the financial markets and the risk attached to them. Treasury Bills. These are short-term debts sold by a government at a discount. Because they are short-term, they are considered low risk. Long-term government bonds. The level of risk attached to them depends on the financial stability of the country issuing them. Their value will fluctuate in line with the changes in the country's interest rates. Because they are riskier than Treasury bills, they have a higher rate of return. Corporate bonds, again a long-term debt instrument. These are riskier than the previous two because a country is less likely to default on paying their bondholders than a company. To protect investors, bond agreements can contain many restrictive covenants. Bonds are credit rated, and the higher or better the rating, the lower the perceived risk. Secured bonds are considered less risky than unsecured bonds. Junk bonds are risky investments and their risk of default is high. Therefore, these high-risk investments offer high returns to an investor. Preference shares. You should already be familiar with preference and ordinary shares. Please look back at F4 share capital if you need to refresh yourself. Preference shareholders are paid ahead of ordinary shareholders and often at a fixed rate, so they are less risky than ordinary shares. Ordinary shares carry the most risk, and when a company is wound down, they are the last to get paid. But they also can make the highest returns. Returns and losses are determined by the rise and fall of the share price on the stock market.